All right, good afternoon, everybody. Can you guys hear me all right?
Clear.
Awesome. Let me go ahead and share my screen again. I'm going to put everybody on mute real quick. Okay. Check the chat one time. Good to go. Okay. So thank you all for coming tonight. Doing this presentation tonight was actually inspired by a tweet that I got on my social media. Didn't know the person, but they were saying I was doing a tweet that was saying S&P 500 has been performing this year, and it's up close to double. There, guys, you got to mute your mics. Sorry about that. So I was talking about how well the market has been performing this year, contrary to belief. And I this retweeted my tweet saying that this year's been okay in the market, this year's been okay in the market, and then the future can be, it's not looking good. So I wanted to get back to the basics and pretty much teach index fund investing and ETF investing again as a core investment strategy for everyone's portfolio, and then to really look into the data on how the markets have performed this year, so we can actually dispel some of these notions on how the market is performing. Because I mean, through different asset classes, if there's any crypto investors in here, obviously crypto has been having a rough month this year. Bitcoin's gone down like 30% since its all-time high back in February. The market itself, the S&P 500 is down for the month as well. So it has been a choppy month in regards to investing. But if we zoom out and look at the whole year, we'll actually see how well the market has performed this year. So a brief introduction of myself before I get started. So my name is Sean Cranston. I go by TheWealthDad on social media and on the Discord. You can always find me by just searching my name in Discord, TheWealthDad, and you can find me there. I'm usually in the index fund, dividends, value investing, and personal finance chats. If you want to find me directly, you can generally pop in there, and I'll be searching everybody's questions in there to answer. I'm 29 years old. I started investing when I was 23. My very first investment was a $57 contribution into my 401k. So in the 6 years since investing then, me and my wife have built upwards to a $350,000 portfolio since then in these 6 years. It's all predominantly in low-cost index funds and ETFs. I'm also a husband and a father, just like I said, mentioned my wife. We have one son and one daughter who's on the way in about 2.5 weeks. We opened up an investment account for my son. He's 15 months old. He has a custodial account, and we've also put in about 5 figures in his account right now into low-cost index funds as well. I've written a book specifically about index fund investing. It teaches you the basics of this investment strategy, how to build and manage your own portfolio. You can find that on my social media as well. And I always list my occupation. I work in data, kind of IT. And that's just to show people that you don't have to come from a formal financial education background. You don't have to go to college and study finance or get your MBA, study economics, anything like that. You can be a regular old person. You can be a cop, firefighter, teacher, nurse, whatever the case may be. You can definitely learn this and develop good financial strategies that'll turn you wealthy over time. So what's the plan today? This is going to be one of my longer demos. So we're first going to go over what exactly a stock market index is, index funds and ETFs, the difference between index investing and actively managed funds, the effective fees on your portfolio, time in the market, why that's so important to get started as early as possible, and then target date retirement funds. These are the primary investment vehicles that are in many of our retirement plans at work. We'll dive in a little deeper into those as well. We'll talk a little bit about 2 different ways to rebalance your portfolio over time. And then the very last couple slides, we'll talk specifically about how the major markets around the world have performed currently year to date. So when I say year to date, I mean from January 1st, 2021 up until now, May 18th, 2021. So we'll look exactly how they've performed and why it's smart to have a diversified portfolio that you're building for the long term. So stock market index, first essentially chapter. What is it? All it is it's a collection of stocks that represent either a entire stock market or a smaller segment of a stock market. So a few examples of this, some major stock market indexes are the S&P 500. This is the largest 500 companies that are publicly traded in the United States. We also have the NASDAQ. This is a big famous or a big ETF that a lot of us are investing in that I've seen in the Discord. This is QQQ, but this tracks 3,000 stocks traded on the NASDAQ exchange. They're mostly technology companies. And then when you get to the NASDAQ 100, that's a smaller segment of the entire NASDAQ exchange. That's the 100 largest, essentially, IT traded stocks on the NASDAQ. The Russell 2000 tracks 2,000 small cap companies within the United States. And it's a good barometer to kind of see how like smaller size businesses are handling or doing in the economy, as opposed to just the large companies like your Amazon, Bank of America, JP Morgan, Walmart in that note. So summary, it's just a collection of stocks that make up either an entire stock market or a smaller segment of the stock market. So what is market capitalization? I mentioned that the Russell 2000 tracked U.S. small cap companies, and the S&P 500 was the 500 largest companies in the U.S. How do they exactly get who is in what type of market capitalization? So on the left, you'll see large cap stocks. Think of this as your S&P 500. Companies with market caps of $10 billion or greater. You have mid cap stocks who are between 2 and 10 billion, and then your small cap stocks are between 300 million and 2 billion. So an example of how to exactly calculate this market cap, I provided an example on the right by a hypothetical company, TheWealthDad Inc. This is my company. So to get this, the math equation is it's the total dollar value of a company's outstanding shares of stock. Now, what does that mean? If you go down, to further explain it, WealthDad Inc. is issuing 5 million shares of stock to the public, and each share is $100 per price. So if you take the market cap at the bottom for the mathematical equation is you take the 5 million shares, times it by the $100 share price, which gives WealthDad Inc., my company, a market cap of $500 million. So if we know WealthDad Inc. is worth $500 million, we'll take this back to the market cap definitions and see that I fall as a small cap stock company. I'm not a mid cap, I'm not a large cap. That 500 million puts me as a small cap stock company. So that's anytime you hear the word, mid cap fund, mid cap stock, large cap fund, things like that. This is what they're talking about specifically. It's just the size of the company. So index funds and ETFs now. We'll talk about a little about the similarities and the differences. The similarities is that they both provide you instant diversification. So for example, if you're buying an S&P 500 index fund like VFIAX, that's Vanguard's 500 index fund, or if you're buying VOO, that's the Vanguard 500 ETF, they're both going to provide you that instant diversification of spreading your money across the 500 largest companies in the United States. They're also predominantly low cost. This means that since an index fund is just tracking a stock market index, it's not trying to beat it, it's not trying to get you outsized returns, your management fee, this is a fee that they'll charge you every year to essentially manage your money, is going to be extremely low. This is a big benefit for index funds and ETFs. And they have a great strong-term track record against actively managed mutual funds. An example of this a little bit is we can use ARK as an example. This is another famous actively managed ETF. A lot of users in this Discord are ARK investors, are interested in ARK, but as you know, ARK has been getting slammed this year, just like many growth stocks and growth funds have been. That isn't to say necessarily that ARK hasn't been beating the S&P 500 over the past 5 years, because it has, but over time, it's hard for actively managed funds to continue to beat the index over time as more money gets essentially invested into their funds, forcing their managers to have to, maybe buy even more stocks that they're comfortable with. But there's a multitude of reasons as to why it's hard for an actively managed fund to beat the index over the long term. A few of the differences between index funds and ETFs there's essentially just two main differences. It's how to One is how to buy and sell, and then the minimum. So in regards to how to buy and sell index funds and ETFs, index funds are purchased and sold after the market closes. So if you ever buy into an index fund like VTSAX, that's a big one, the Vanguard Total Stock Market Index. Sometimes you'll place a buy order and you see it doesn't execute during the trading day. You might not understand why. That's because it waits until the end of the trading day to get essentially all of the calculations for all the underlying stocks, and then it transacts after the market closes. So the next morning, you'll essentially see your index fund purchase was completed, or if you did a sale, the same logic. For ETFs, they trade throughout the day like stocks. So if you're purchasing an ETF like VTI or VU, you can, if you log into your computer at 1 p.m., the market's open and it's trading at $150, you can buy it for $150 right there. It's just like a stock. The minimums, this is a little different. So most index funds now don't have initial investment minimums outside of Vanguard. Most of their index funds require a $3,000 initial investment. This is your VTSAX, VFIAX. But ETFs, fortunately, you just need the cost of the share price. So if you're if you're looking to get into an index fund with Vanguard that has a $3,000 minimum, you can go to their ETF version of that index fund and just purchase it for the cost of the share price. Many brokerages now are allowing you to do fractional purchases of ETFs, so you don't even need the full dollar value of the ETF. You can just buy a fractional share. I believe Fidelity is doing this now. It's not allowed on Vanguard yet. I'm not sure about Schwab for the main brokerages, but they are starting to allow fractional shares of ETF purchases. So the differences now, we kind of talked a little bit about actively managed funds and with ARK, and then the difference between indexing. What's the primary difference between the two? So index funds and ETFs usually just track a stock market index. Once again, if I have an S&P 500 index fund or ETF, all its job to do is to track the 500 companies that make up the S&P 500. An actively managed mutual fund, on the other hand, is trying to beat that index. So we'll use ARK again. If you go to ARK's website or their brokerage page and you go to the performance of ARKK, that's their flagship innovation fund, you'll probably see that it's matching its performance against the S&P 500 to show how it's beaten it over time, or what its performance to that market or to that index has been over time. So it's trying to actively beat it. But the big drawback in trying to beat that index and investing in actively managed mutual funds, if you go to this image on the right, this is a little bit breakdown between the two, or a further breakdown. The fees involved with investing in an actively managed fund are a little bit higher because you're paying for quote unquote outperformance. So your expense ratios for an actively managed fund compared to an index fund are usually 0.5% to maybe an entire whole percentage point higher when investing in an actively managed mutual fund. We'll go into an example of how paying for that potential extra in fees might not be worth it over time. So the true cost of fees. Let's use two investors as an example, Amber and Tony. Both open a Roth IRA. Amber uses Vanguard, Tony uses Fidelity. The main difference is Amber's going to take the passive index investing route. She's going to invest in the Vanguard 500 index fund with a very small expense ratio, 0.04%. She's going to manage the account herself, and she's going to invest from the ages of 25 to 60. That index fund is going to return her hypothetically 8% annually. And by the time she gets to 60, she has accumulated over $1.1 million. So Tony, on the other hand, invests in an actively managed mutual fund. Let's say he's investing in ARK. We'll use that as a hypothetical. But he also hires a financial advisor to manage the account for him. So he doesn't have to do any of the purchase and sale or selling or rebalancing. He's going to let the financial manager do all of that for 0.5 percentage point a year. He also invests from 25 to 60, and his investment actually returns 0.5 percentage point more per year than Amber. So his annual return is 8.5% compared to 8% to Amber. But at the end of his retirement or investment timeline, he actually accumulates a little, about $200,000 less than Amber. How's that the case? He got a higher return that should have gotten him essentially a higher dollar amount in the end. But if we actually look at the actual numbers, Let's take a look at the returns and the fees. So Amber's return was a little less, 8%. Tony's was 8.5%. But he was paying for the, once again, the quote unquote outperformance, but he was paying for that in a higher expense fee. So his expense ratio was 1% compared to Amber's 0.04%. Amber also didn't hire an advisor to manage her funds. She essentially did it herself and just did the purchases and sales and rebalancing herself. But Tony wanted an advisor to do that. So he paid an extra 0.5 percentage point to the advisor as well. So if you add up the expense ratios or all the fees for Tony, he paid 1.5 percentage points total a year in fees. So if you would take that 1.5% and subtract it from his 8.5% annual return, and that actually gave him a real return of 7% a year. Amber's real return was 7.96 because she was only paying that 0.04 percentage points. So the real return over time was actually in favor of Amber because she wasn't having those extra fees drag down her portfolio. And if you see in the end, all that she lost to fees in over that 35 years in investing was a little over $11,000, to where Tony almost lost $250,000 in fees. So although he outperformed technically in investment returns, those fees ate away at his portfolio slowly over time, which he probably didn't notice while in the short-term years when he was investing. But at the very end, it's extremely costly because fees compound just like investment compounding does, just in reverse. So finding your fees, quick demo real quick on how you can find your fees if you're looking for them in your investments. I'll use Vanguard as an example. First, we'll go to Fidelity and Schwab. Actually, I'm just going to Google VTSAX. So if I was any of you, I would just go to Google, search my fund, and you'll usually get a summary page of your fund. This is the first place you can see your fee. So expense ratio right here, 0.04. That's actually where I got Amber's example of 0.04. So you can also go to their website. And each of their funds will normally have a fees tab on the main site. So you see price performance, portfolio management, fees, and minimums. This is where we want to go if we want to dig a little deeper. So expense ratio, once again, 0.04. So Fidelity, well, let's look at Fidelity. Fidelity's 500 index fund. You can see it again, expense ratio on this chart. And on their website, I believe it's actually on the very first page on their summary page for the fund. Yeah, so if you scroll down to details, you'll see the expense ratio right here, 0.015, another very low fee fund, great index fund. Schwab's, their user interface is pretty good too. Vanguard's is kind of the oldest oldest UI out of all of these. Schwab and Fidelity definitely have better websites to look through. Let me make sure I get their actual website. Okay. Okay, so Schwab will give you a little bit more of writing summaries at the beginning. But if you scroll down, you'll see there in their details section, they list the fees as well, 0.03. So that's one way to find that initial expense ratio that we're talking about in that example above when we were seeing the true cost of fees. That's your expense ratio right there that I'm talking about. So you're always going, whatever fund you invest in, you are going to pay an expense ratio. There are a couple zero cost expense ratio funds that Fidelity has introduced in the past couple of years. FZROX, they're called their zero cost funds. But for the most part, almost all mutual funds and index funds are going to charge you that expense ratio to manage your money every year. Time in the market. Why is this so important? Compounding interest. Another example, Sally and Sean, two different investors. One starts at 22, right when they start working. One waits until their income grows a little bit. And they have a little bit higher income where they think they can start investing more, and starts at 32. So both open a Roth IRA, invest $500 a month into an index fund. Both are in 8% a year. Once again, the only difference is Sally started 10 years earlier than Sean. So you'll see that Sally contributed $228,000 over the course of 38 years, where Sean contributed $168,000 over the course of 28 years. Not the biggest difference, about $50,000. But in the final value of their accounts, Sally almost more than doubled the final value of Sean's growth. And this is because she had that extra 10 years of compounding. And what do I mean by compound interest? If you don't know what compounding is or compound interest, this is a great quote that I stole from a Forbes contributor online, Kate Ashford. She said, with compound interest, you're not just earning interest on your principal balance, even your interest is earning interest. So compound interest is when you add the earned interest back into your principal balance, which then earns you even more interest. So what that essentially means is the money that you invest is going to earn you money. And then as you reinvest that earned money that was just reinvested is also going to earn you interest. And it creates this snowball effect that continues to build upon itself and build upon itself and build upon itself, to where in the later years of your investing, where you're getting a sizable amount in your portfolio, it's almost returning you more than your 9-to-5 salary due to the amount that it's growing. So if you look in an example on the right here, I start with just essentially a initial $1,000 investment. I never add anything more to this, but the hypothetical scenario is that this $1,000 is going to earn 10% every year for 20 years. And you'll see in the first year that 10% earns me $100 in interest. 10% of 1,000 is $100. So in year 2, I start off with 1,100. Except in year 2, my 10% return earns me $110. That's because not only is my $1,000 initial investment earning 10%, but that $100 that in interest that was earned on my initial investment is also earning interest. And then if you plug that into year 3, I'm earning $121 in interest, then $133 in interest. And if you fast forward all the way to year 20, I earned over $611 in interest. And this is, once again, just how your money is compounding and building on itself as you reinvest your earnings, your dividends, your capital gains. This is why it's so important to reinvest these earnings so it can keep building off of itself. But this is compound interest kind of explained in a nutshell for you, and hopefully you kind of understand it a little better. And when I said too, once again, that your fees compound just like money, this is how in reverse, that example of Sean, or I think we used Sean, who invested in the actively managed fund with also an extra fee for the financial advisor. That's how his fees were also compounding over time, over the course of 35 years. So instead of it growing money, that fees was actually eating away money over time, to where it got to the point where he lost over $250,000 in fees. So hopefully that explains compound interest a little better, gets it a little bit more clarity for you guys. So target date retirement funds. These are the predominant investment vehicles within our work-sponsored retirement plans. That's your 401ks, your 403bs. If you're in the government or military, this is your TSPs accounts. And what they are is essentially a fund of funds. So you invest in one target date retirement fund, for example, like a Vanguard 2055 retirement fund. But in that fund, it's made up of a collection of funds, normally with at least 4 different types of assets. So it's usually made up of a U.S. stock market fund, an international stock market fund, a U.S. bond fund, and an international bond fund. And what it does is it automatically rebalances your holdings over time, so you don't have to worry about it. So this is a great investment vehicle to use for people who are very hands-off with their investments, who don't want to look at the stock market, don't want to essentially rebalance their own funds over time. If you just essentially are checking on your portfolio like every quarter or every 6 months, every year, this might not be a bad idea for you to invest in. And how they're kind of designed is you pick a retirement or a target date fund that corresponds to the year you plan to retire. So in the 2 examples at the bottom, I list a 25-year-old investor and a 45-year-old investor. So a 25-year-old investor who's expecting to retire at age 60 would need to invest in a target date fund that is essentially 35 years from now, the difference between age 60 and age 25. So 35 years from now would be 2055. So that 25-year-old would invest in a 2055 fund. And then the 45-year-old would invest in a 2045 fund. So you just want to pick the year that most corresponds when you actually expect to retire. So what makes up a TDF? I said that it's essentially a fund of funds. Let's see exactly what that means. So all I'm doing is essentially going to Google and I'm Googling the Vanguard 2055 target date retirement fund. So I'll click on their website. Once again, we'll check their fees as well, because not all target date retirement funds have low fees. Vanguard's does. Fidelity has low fees. Schwab has low fees, but some 401ks and 403bs have terrible fund options, and it's from really small brokerages, and their fees I've even seen like target date funds that have like 1.5% in management fees. So always first go to that fees and minimum, see what you're paying. 0.15. That's not bad. The reason that expense ratios are a little bit higher for target date funds is because, once again, they're managing this portfolio for you. So if we look in the portfolio and management for the 2055 fund and scroll down, you'll see that this is made up of 5 underlying index funds itself. So you're paying that extra little bit of expense ratio for them to manage this for you over time and rebalance this. And I'm going to use Schwab because they have a great kind of chart that shows how this changes over time. Scroll down for okay. So this chart right here, I'll explain it because it might look confusing at first. So Schwab actually, their target date funds are actually made up of many more funds than just 4 or 5. They've got like, what's that, about 8 funds. They even have REITs in there, which are real estate investment trusts. So they're made up of US stock funds, international stock funds, real estate funds, and international funds as well. But the purpose of a target date retirement fund is essentially the younger you are and the further you are away from retirement. So if you look on this far left, when you see minus 45, this is signifying that the investor is 45 years away from their retirement, this little white dot. So they have a long time to go until they're going to retire. So what a TDF is going to do is it's going to initially put this investor in a aggressive style type of asset allocation. So it's going to be more geared towards stocks, real estate, and less towards safe investments like bonds or treasury bills. That's this kind of big chunk right here. This dark blue and blue, this is your more aggressive investments. But as you see, as it gets closer to retirement, these more aggressive investments are actually shrinking in terms of the total weight in its portfolio. And these safer investments like bonds, treasury bills are increasing. That's because as you get closer to retirement, the fund wants your portfolio to become less volatile to short-term swings, so that you're not essentially losing all of your money right as you're about to retire. If we use last year as an example, 2020, back in March, the S&P 500 plummeted about 33% in 1 month, March. You could imagine somebody retiring kind of in that first quarter or second quarter of 2020 would have gotten a little nervous if they were just in a stock index fund to see essentially, let's say they had $1 million account all in the S&P 500 index. Well, then they plan to retire, and then all of a sudden that $1 million account is worth $750,000 now because it lost, or even more than that, about $700,000 because it lost a third of its value. So how essentially some people protect against this is just going into a safe target date fund, so where that it limits that short-term burden if your aggressive stocks tank in the short term, because it's really well balanced between safe investments and growth investments. So portfolio rebalancing. This is very important because I see this a bunch in the chat too. I see a lot of people will say, hey, I'm invested in VTI and VU, or I'm invested in these funds. Do they overlap? Should I reallocate? Should I consolidate into one? So let's talk about how we kind of rebalance a portfolio. So I'm going to give an example at the beginning, and then I'm going to show 2 ways on how to rebalance it using 2 different strategies. So at the very first year, we invest $10,000 into 4 investments: a growth and income, growth, aggressive growth, and international. These are just hypothetical made up asset classes. Each get 25% each to make these numbers easy to kind of do the math on. So each investment gets $2,500 towards their asset allocation for a total of $10,000. So at the end of hypothetical investment year one, as you see, growth and income increased $1,000. Our growth investment increased 500. Aggressive growth had no return, and our international investment lost $500. So what happens though is that as those funds were either increasing in value or decreasing or not moving, our allocations got out of balance. So our growth and income is now 32%, growth is 27, aggressive growth is 23, and international is 18%. That's now out of balance from what we want as 25% for each fund. How do we go about rebalancing this? First way, this is what you're going to do in the easiest way to do in your retirement plans, like your 401k, your IRA, TSP, 403b, 457. You're going to sell your winners to buy more of your losers. So before we know how much we have to sell in each, we have to figure out how much to get back to our initial 25% allocation. So the math is very simple for this example. We're going to take our portfolio value right now, which is $11,000, and times that by 25%, which in a decimal is 0.25. And that means to get each back at 25%, we need each investment to have $2,750 in it. So what we did is we sold 750 growth and income, sold 250 of growth, and then bought 250 of aggressive growth and 750 of international. We sold the winners to buy more of the losers. So what this did is we essentially took profits from our big winners and then reinvested those profits into our losers, and it rebalanced itself back out to our desired 25% allocation for each. Each now has $2,750. And it's easy to do this, and the preferred way to do it in a retirement account because they're tax sheltered, they're growing tax free. You don't have to worry about paying capital gains taxes on your profits like you do a brokerage. If you were doing this in your brokerage, when you sold off that 750 and 250 in your growth and income and growth, you're going to have to pay capital gains taxes on those profits. So now that we're talking about brokerages accounts, and we said, that's probably not an ideal strategy to use for that because you have to pay profits. What do you do for your tax brokerage accounts? You're actually going to essentially just buy more of your losers. So you're not going to sell your winners. You're going to buy more of your losers. Sorry, let me make sure I mute everybody again real quick. So we're going to use a different, instead of, we're going to use the same ending portfolio value of $11,000 from that hypothetical first year investment. But what we're doing is we're going to contribute $3,000 of new money. So $3,000 of new cash flow we're going to invest into this new into our portfolio. So our portfolio value increased from $11,000 to $14,000. So this is the same math as the first one to find how we figure out what's 25% of $14,000. You just take $14,000, times it by 0.25, 25%, and that gets you a final value of $3,500. So we need each investment asset class to hit that $3,500 mark to get our asset allocations back to 25% each. So what we're going to do with that new money is we added $500 to growth, $1,000 to aggressive growth, and $1,500 to international. So instead of selling these like we did in the first example, to sell the winners to buy more of the losers, we're going to just simply buy more of the losers with new money so we can avoid paying those capital gains taxes from profits because we're in the taxable brokerage. You have to remember what account your money is sitting in. If it's in a retirement account and it's protected from taxes, you don't have to worry about the capital gains tax, and you can just sell the winners, buy more of the losers. But if you have a taxable brokerage, you have to be mindful of those capital gains taxes. And you're going to pay, there's either short-term capital gains and long-term capital gains, depending on when you pay it. So if you're selling some of your profits in investments that you've held for less than a year, you're going to pay your regular ordinary income tax rate as opposed to the lower long-term capital gains rate. So in this event for a taxable brokerage, this is how I do it for my account. I just simply buy more of my losers so I don't ever have to worry about paying that capital gains rate in the end. So last chapter, we're going to look at the major indexes return again, because once again, I think there's a lot of unknowns, or some people might actually not have a good idea of how the stock market or market indexes have performed this year, and that's just because a lot of assets have gone kind of south in this month of May. I mentioned crypto at the beginning. Crypto's been getting crushed. ARK's been getting crushed. A lot of technology stocks have been getting crushed. So let's actually look at how the market has performed this year. And once again, when I say year to date, I mean from January 1st, 2021 up until this point, May 18th, 2021. So this is a snippet from the Wall Street Journal, actually on Monday. I accidentally threw away the paper from today. So this is a day, this is 2 days in the past. So the major US indexes. If you look towards the bottom here, the 500 index, this is the S&P 500. Its year-to-date performance is actually over 10% so far this year. When I took the snapshot for this, it was 11%. But if you just bought essentially invested $5,000 into the S&P 500 on January 1st, your investment is up over double digits so far this year. So if you just bought and hold, you actually did fine if you're in the S&P 500. If you invest in the total stock market, that's your VTSAX, you're up a little over 10% as well. NASDAQ, this is your QQQ, hasn't performed as well as the overall market. The NASDAQ crushed last year. The technology stocks were pumping last year, but it's kind of reversed this year. Utilities, materials are doing really well, energy companies. So that's kind of why you see the NASDAQ is not performing as well as the S&P 500, which is more diversified into 11 different sectors as opposed to just technology. And actually the mid cap and small cap indexes have performed even better than the S&P 500. So mid cap was at 18% yearly return, and small cap was at 21% year to date return. So some of the index funds and ETF ticker symbols that you can use to invest in these stock market indexes, as you've seen, they're all, the NASDAQ was up, or was the smallest one. It was still up about 4% so far this year. You're still up. And the biggest ones are QQQ, the ETF, and then Fidelity also offers their own NASDAQ fund. That's FNCMX. The S&P 500, Vanguard's index fund is VFIAX. Their ETF is VU. SPY is another one. And then Fidelity's is FXAIX, and Schwab's is SWPPX. Mid cap for Vanguard, VIMAX. VU is the ETF. And then Fidelity and Schwab are FSMDX, SWMCX. Small cap, you can read those off as well. The only thing to make note in here is these Vanguard funds, the ones with the 5 letters, these are going to be your $3,000 initial investment funds. And then, but to the right of them, your VU, your VO, VB, those are the ETFs where you can purchase for just the cost of the share price. Fidelity's funds and Schwab funds don't have the investment minimum, so you don't have to worry about that. But these are the funds that you can invest in that have performed, well this year in their major stock market indexes, if you're just going to do it buy and hold for the long term. So this is going to be a little bit harder image to see. This is the international stock indexes. This lists almost essentially every major index in Europe, Asia, South Americas, but I highlighted the very top because these are the main important ones that I recommend you kind of look at. This is your total world stock market. That includes the US market, as well as other developed markets like Canada, Europe, spacing here, Japan, Australia, and then also emerging markets. This is your Hong Kong, India, Mexico, Russia, China. It's been a little up and down in the international markets. If you see this one right here, the MSCI ACWI excluding USA, this essentially just means the international market excluding the United States. So developed economies or developed markets, emerging markets combined into one have returned close to about 6% this year. Europe's done a lot better. So the stocks Europe 600 is up almost 11%. Oops, sorry. And if you scroll down, these are just a bunch of indexes. Germany's up about 15%. France is up 12%. So Europe's actually had a really good year this year in the stock market. Asia, not so much. These are a lot more of your emerging economies. So kind of hovering around 0%. That's where you see emerging markets is actually kind of like the lowest performing of international markets, 1.3% compared to Europe's higher double-digit returns. And that's where you see when you combine those two, that's why it's only about 5.5 or 5.7% return. So a couple funds and ETFs you can invest in internationally. Total World Index, VTWAX, or the ETF is VT. And once again, Total World is the US, including the international markets as well. So it's like a one-stop shop. Developed markets, if you just want the developing economies, once again, this is your Europe, Canada, Australia. VTMGAX is a fund. VEA is the ETF. Fidelity's version is FSPSX, and Schwab's is SWISX. Emerging markets is VEMAX. The ETF is VWO. Fidelity's fund is VPADX. Schwab's is SFENX, and their ETF is SCHE. In my opinion, I wouldn't try to buy the developed and emerging markets separately. I would just get essentially a total international index fund that's going to combine both of them together, and you don't have to worry about that. That's what I hold in my portfolio. It's VTIAX. It's going to put developed and emerging in there, and you don't have to worry about kind of rebalancing over time. But those are just some of the indexes that you can invest in internationally. So that concludes the presentation. Hopefully you guys got something out of that. Hopefully you picked up another tool to your arsenal. This is just another investment option. And I'll open it to questions. I'll take about 5 to 10 questions. You can either put it in the chat or just feel free to ask me.
Hi, I have a question.
Mm-hmm.
So I'm 25 years old and I just opened a 401k when I started my new job.
Okay.
And like obviously I don't plan on staying there long term. And I also recently opened up a Roth IRA account.
Mm-hmm.
So would you recommend when I leave that job, because they have a 6% match right now, like
Mm-hmm.
is there any way I can roll over that 401k, which is with Fidelity, into my Vanguard Roth IRA account?
Yeah, you absolutely can. The first thing you just have to check is if you're funding a traditional 401k or a Roth 401k with your company. If it's a traditional 401k, which most companies just automatically opt you into the traditional 401k, you're going to have, or it's either you are going to have to open it or Vanguard will do it for you when you do the rollover, but it'll roll that traditional 401k into what's called a rollover traditional IRA. And it'll have the money sitting in there. But because if it's sitting in a traditional IRA money, that was taxed differently than Roth money, it can't just essentially get plugged into a Roth. You would then have to take that traditional money and then convert it into a Roth if that's what you want to do. Does that make sense?
Yeah, it does.
Yeah.
All right, thank you.
Yeah, no problem. I actually did that this past year. I was rolling over my 401ks a bunch, and I had a lot of money sitting in a traditional, and I think it was like 44 grand of my 100, and I rolled over like $120,000 total, but $44,000 of that 120 was in traditional money. So I had to do a backdoor, not a backdoor conversion, but I had to then convert that 44,000 of traditional money into my Roth IRA. It was like a 2-step process.
Thank you.
Yeah. So this is a question. What's the max number of retirement funds? I think you mean accounts that you can have. And you can do a Roth or a 401k. I don't know if there's a set amount that you can have. So you can open up, in terms of like IRAs, you can open up as many as you want to, but you're still only allowed to contribute $6,000 a year total from all of them. Also, if you're a business owner, you can open SEP IRAs, solo 401ks. So there's a lot of accounts you can open. You don't need to open a lot of accounts though. I just have a 401k, an IRA, and a SEP for my business. I like to actually keep the less accounts for me, the better, because it's the less I have to manage. So hopefully that answers your question a little bit.
How often do you have to rebalance per year, or do you just do it annually?
Personally, I do it annually. Some people do it quarterly. I think that's too much. I think the safe times are either doing it twice a year or just once a year. So doing it on, if you're gonna do it twice a year, do it on like January and then like June or something in the middle of the year. But you'd be just fine doing it once a year, or twice a year. You don't have to go too much more into that.
And when do you usually do this process?
When do I do it?
Yeah.
Okay. So with my retirement accounts, because once again, I don't have to worry about paying taxes. I can just do this selling and buying. I'll do this either like kind of at the end of December or beginning of January, depending on like when the trading days are. So sometime around then. For my brokerage account, on the other hand, I actually kind of do this. I know I just said don't rebalance more than like twice or one time a year. I actually do this almost on a monthly basis because remember I said when you're in a brokerage, but just keep essentially using your new money to buy more of your losers. So I'll do the math on like where my asset classes are at the end of each month, and if they're like crazy out of balance, like one's like 5% more than the other one, if it's that much of a difference, I'll add even more of that new money towards that one that's not performing as well. And then that essentially buy process happens on a monthly basis if it ever gets too out of hand. Does that make sense?
Yes, it does.
Yeah.
Thanks for the info.
Yeah.
I had a side note. I appreciated the lecture, was really good. I'm actually finishing my my master's of information systems.
Nice.
And I want to message you on IG possibly about, because I'm trying to come up with some business ideas. It's kind of off subject, but
yeah, sure. Shoot me a message on Instagram.
okay.
Just give me some time. Tell everybody if you got specific requests, always DM me, but I get a bunch now on Discord, Twitter, and Instagram. So just give me some time. If you reach out to me and I don't get back to you immediately, I know you're going to contact me, so I'll contact you either probably tonight or tomorrow morning. If you don't hear from me by like 12 o'clock tomorrow, just ping me again, and I'll make sure that I can get in touch with you.
Okay, cool. Thank you.
Yeah. So this question, does an aggressive growth IRA account act in the same manner? I'm not sure exactly what you're asking. I think you may have misunderstood what I was. You probably got aggressive growth from the asset allocations I was talking about during rebalancing. Aggressive growth, I was using it as an example for an asset class, not specifically a IRA account. So if you can reframe that question maybe a little bit differently or ask it again, I'll try to answer that for you. And this recording will go on I'm going to look at the Discord real quick to make sure I get the right chat. It's going to go on the Wealth Squad University chat. That's where all of essentially the creators' videos go. I think they update it on a weekly basis, so you'll be able to find that there. Oh, someone just answered that. Thank you.
Hi, I have a question. You mentioned in the beginning that you had a custodial account for your children.
Yeah,
Can you talk a little bit more about that?
Yeah, sure.
I have 2 529s for my daughter that I'd like to move into something that's more flexible and rewarding.
Yeah. So I've done, if you actually go through the Wealth Squad University, I've done a video kind of breaking down the two a little bit more if you want to like take a little bit more time to hear kind of my thoughts on both. We actually opened a 529 for my son first and funded that first for like a year. He had like $10,000 in it. And then we made the switch to a custodial account and actually transferred the assets to the custodial. We did pay a little bit of a fee for that withdrawal. It really comes, I don't think there's a bad option between the two. It really depends. It depends on two things: how old your kids are and how far away they are from like college, and where you see college going. So why I say that is because my son's 15 months old. I personally think college is going to be a lot different in about 17 years, both financially and both the time it's going to take. I don't think 4-year traditional college paths are going to be there. I think it'll be more 2 years specialized. So I think that whole dynamic is going to change in 17 years. So I felt comfortable doing that move to a custodial because I believe he'll get the biggest benefit out of it. But if my kid was like 14 or 15 and only a couple of years away from college, I'd probably stick with the 529 because I wouldn't think that there'd be that much of a sizable change in the next couple of years to the traditional university route. And it's probably still the best route if you plan to go kind of a white collar role, or if you're going into medicine or law. So it kind of really depends. How old are your kids, and what's the goal for your money?
Got it. Got it. Thank you so much.
Yeah. If you want to talk to me a little bit more specifically, feel free to DM me in the Discord at TheWealthDad, and we can talk about your situation a little bit more if you want.
Thank you. I will do that.
Yeah. But if this is a good question, so this person's asking about the portfolio rebalancing when I was saying sell your winners to buy more of your losers, but because they said, but if it's a loser, wouldn't you want to invest in something else that's going to be a winner? No. Once again, this is where it's so important to figure out what your asset allocation is at the beginning and to stay consistent with it over time. Because remember, let's just think of this concept this year and last year. So one of the biggest losers this year has been tech. What was the biggest winner last year? What was crushing it last year? Tech and growth. These different sectors go in cycles. And that's not a bad thing. That doesn't mean that it's a bad investment. It's just the natural progression of markets over time. So they're not necessarily losers. What you're doing is you're buying your assets that are underperforming that year, and you're buying them at a cheaper discount than you would be for your winners. So remember, not every winner is going to consistently be the winner every single year. Real estate's going to win one year, and then tech's going to win, and then energy is going to win. But don't go chasing returns. Don't go chase the asset that's always winning. Make sure you're buying more of your lose. Chris Johnson talks about this in some of his tweets sometimes. Last year, he was buying a lot of value and dividend companies because those were the hardest hit sectors. And now they're popping this year. And now that tech is not doing well, he's buying tech because that's the natural cycle of the markets. Buy more when your assets are going down so that you can buy more of the value. And then when they shoot up, that's more of your money that's going to be increasing. So hopefully that answered you a little bit better.
Hi there. I'm not sure if you can hear me. I'm kind of new to the whole Zoom thing.
Yeah, I can hear you.
Oh, okay. So I'm hoping to kind of talk to you a little bit offline too, because I don't really feel 100% comfortable saying everything. But so
No problem.
I'm 33.
Mm-hmm.
I just sold my house last year, so I have profits from that. And
Okay.
I've been very scared to like touch them or do anything with them. I don't know
Sure.
where to start, and I've done a little crypto and stuff, and I just want to be very smart with moving forward with what I need to do. And I'm currently not working. I received some money from another source, so I'm just trying to figure out if we can speak offline so I can kind of divulge more into that, if that's okay.
Absolutely. Like I
Okay.
said, if you're new to the Discord, just open the app and go to the hourglass, I think it is, or the magnifying glass at the bottom, and search the Wealth Dad and shoot me your details there, and we can talk.
Perfect. Thank you so much. Great class, by the way. Thank you.
Yeah, my pleasure. Is it better to do the ETF first if I don't have enough to invest in the actual index? If you're using Vanguard, yes, because once again, they're the only brokerage that has that $3,000 initial investment for the index funds. So you'll have to almost do the ETF. So you could essentially buy, if you want to invest in the S&P 500 index fund with Vanguard and you don't have the 3,000, just invest in VU and then build that ETF up. That's actually what I do. I manage a retirement account for one of my close friends, his IRA, and he doesn't have the $3,000 yet. So he just plugs money in, or he contributes on like a weekly or biweekly basis. And when he has enough to purchase an ETF, I'll do that purchase for him. And then when he gets to the index fund, we'll do the switch then, and it'll let him then just automatically contribute into the index fund as opposed to waiting for the ETF.
Hey, Sean.
Yep.
Hey, I basically have the same predicament as the young lady that was just talking with you. What would you say? Go to the hourglass on the Discord and how do what now?
Yeah. Are you on the mobile app?
Say it again.
Are you on the phone app?
Yes.
All right. So you see the 5 icons at the bottom. The one in the middle should look like an hourglass or a magnifying glass. Sorry. Do you see that?
Okay. Yeah, I'm searching on it now. I can find it. I'm just writing it down.
Okay.
I'm actually on my phone and doing everything. I don't want to lose you.
Sure. So yeah, just search for that magnifying glass and it'll pop you up and then in that search bar, just type the Wealth Dad and you'll see my my name and face come up.
Okay, appreciate it.
Yeah.
Hello, I have a question.
Yeah.
My son is 10 and he does work.
Mhm.
I would like to open up a Roth 401k for him. I noticed that I think it was only Schwab and Fidelity, and Vanguard as well that offer it. Do you have any information, offhand about which company would be best to go with for a child's Roth 401k?
So is he does he have a job or does he like work for like your family business or something?
No, he actually has a job. He works in modeling and acting and commercials, so he gets a paycheck for
Nice.
that.
So you're going to open what's called a Roth IRA, not 401k. So 401k is like a, yeah. So he's probably like a private, I guess like a private contractor kind of, I'm guessing.
Yes.
Or you legit get a paycheck on the payroll.
Yes.
Are you saying yes to like a private contractor?
He does receive, he receives a paycheck from his agent from the agency. Yes.
Sure. So I would open a Roth IRA, not a 401k. And then I would use Vanguard, Fidelity, or Schwab are all great. My preference is just to use Vanguard, but you can't go wrong with either. This is how you would do it if you don't know how. Just go to Google, type in open Vanguard Roth IRA, and then I think that's like the third account after the ads. Open an IRA account, 3 easy steps, and follow them. It's going to give you this button right here, open your IRA, and then you'll just put in his information. You'll have to set up an account under like all of his name, his employment stuff. And then you'll be good to go to transfer or link your bank account to Vanguard and then invest the money for him. Does that make sense?
Yes, perfect. Thank you. Because currently he just has a savings account through TD Bank, which doesn't have any interest. And he's got a nice amount. So I would like for him to put in an account where it could actually grow.
Yeah,
Thank
sure. The only thing you have to make note of is he still has the same limit, contribution limits per year, which is $6,000. He's allowed to start funding 2021 now. The timeline to fund 2020 is now over, but he can, how to say this right? He can only invest he earns to 6,000. What I mean by that is if he only earns $3,000 from modeling in 2021, he can only put $3,000 into his Roth IRA. Does that make sense?
Absolutely. Thank you.
Put, like saved money in there if he's not earning as much as that.
Okay, that makes complete sense. Thank you.
Yeah, no problem. Where did the chat go? Top indicators that I look for when analyzing, and I'll do index funds, ETFs, fees, expense ratio. That's the first one. I always go to make sure that expense ratio is as small as it can be. My preference is to get your fund underneath 0.05% for the expense ratio, and then also I'm going to look how well that fund is matching the index, and let me show you what that means. Let's look up Vanguard 500 Index Morningstar. So I'm going to go to the performance for the Vanguard 500 Index Fund. And what I want to see is that I want to make sure that this index fund's actually tracking the S&P 500 so that it's not earning significantly less. I want to make sure it's actually doing what its job is doing. So if we see, let's go to the chart right here. The index is red. That's our fund, VFIAX, or no, VFIX is blue. My apologies. And the S&P 500 is this red. So as you can see, these lines essentially are the exact same over time. The index has performed a little better or the S&P 500 has performed a little bit better than the S&P 500 index fund, but that is just because the index fund has those tiny expense fees. That's how it should be happening. Your fund will be returning whatever the market's returning net of those expense fees. So I want to make sure I'm paying a low expense fee, and then I want to make sure that the fund is actually tracking the market index. Because if I rolled in here and saw that this index fund was like, let's say the yellow line, then obviously my index fund isn't set up properly and it's not actually tracking the S&P 500 well. Hopefully that answered your question.
Do you know of an example of one that's not tracking well? Like, what would be the percentage that it would have to be to decide not that it's not tracking well?
I saw one a couple years ago, and it was from a small fund family. I couldn't even remember like what their name. It was the most random name. It was like Johansson Family 500 Index. It was in someone's work retirement plan. It was a small company. But it was losing. What was it losing by? It was enough to where, like, if you pulled up a chart, you would see a noticeable like mini gap. But the main difference was actually just the expense ratio was so high. So it was like a 1% expense ratio, which is ridiculous for an index fund. And that over time was just eroding the return of the investment. But most major indexes from brokerages like Fidelity or Schwab, if you pulled up their accounts compared to here, you'd see that they're all tracking pretty much the exact same. You would have where I would really check is if you see like a 500 index fund or any of these major indexes from families that aren't the major brokerages like Vanguard, Fidelity, Schwab, State Street's a big one. But if you see like a fund that has a weird name, always check and see if there's a big kind of delta between the two.
Hey, Sean, I got another question for you.
Yeah.
Does your course teach you like step by step how to open up, like say like if I open up a TD Ameritrade account and go to index funds and show you how to, walk you through how to get set up and starting one?
So in terms of like step 1, step 2, step 3, like how to like a tutorial of how to like open an account, input your information, link your bank account. No, my ebook does not teach you that. You can go to YouTube and Google very easily like open fund Vanguard IRA, and there's most likely a 2 or 3 minute video that'll teach you that. What my book will teach you is that would be valuable to you is it provides 3 sample portfolios off of kind of major big portfolio models out there. One's the Dave Ramsey portfolio. One's the David Swenson portfolio. He ran and operated until he passed actually this past month. Yale's endowment portfolio. He kind of revolutionized institutional endowment investing. And then the 3 fund portfolio. And then within each of those different sample portfolios, I list the index or the asset allocation percentages, and then the Vanguard, Fidelity, and Schwab index funds and ETFs to use for each of those portfolios. So the book will give you examples of different portfolios you can use in real life with the actual funds and ETFs. And then it'll go like essentially do this same type of rebalancing chapter where it'll show you how to then manage it over time. That's what my book will teach.
Gotcha.
Yeah, no problem.
So going back to what you said about the 25%, I'm looking at my retirement fund now, and I just let my company do whatever, and I never looked at it. And so should I be looking at the portfolio weight, and that's what it should be equal to? It should be equaled out in the portfolio weight, or?
Well, I'm guessing if your company most likely just puts you in different investments, and do you know which ones they are? It's okay if you don't.
I see the market sectors that it's in, and like the different securities. So heavily weighted upon government, then corporate bonds, then mortgage backs, then cash, then everything's pretty much bond heavy, it looks like.
Do you mind if I ask how old you are?
I'm 30.
So you're very young in your investing life. You don't need to be that conservative. You would want to be more geared towards stocks. So to answer your question, I wouldn't say I would rebalance to their asset allocations. I would first find an asset allocation that you are comfortable with. So for me, and as an example, I'm a 29-year-old investor. I'm an aggressive investor. So for my retirement accounts, I'm 100% stock based. Not everyone is going to be that aggressive. A rule of thumb some people use is take like 110 and then subtract your age. So you said say that again, you're 30?
Yeah, I'm 30.
So if you took 110, subtract 30, that would leave you at 80% stocks and then 20% bonds. There's even like I think they say aggressive investors can do 120 minus your age, which would put you at 90% stocks to 10% bonds. So the first step for you is going to be figuring out what you want your allocation to be based off of your goals and your risk preference. Then once you have an understanding of what your asset allocation is, you can then rebalance it based off the funds within your account. Does that make sense?
Yeah,
If you want to talk about it a little bit more offline,
I probably will.
and then we can, no worries. We can look at the fund. You can like take screenshots of the funds you have, and then we can talk a little bit more in detail.
Okay, that works. Thank you.
Yeah, no problem.
I had a question. I actually was wondering, since you're on your laptop, you could possibly walk this through. So there was this link in the chat, in one of the chats that I saw. It was a resource on how to like compare and contrast like different ETFs. The website was called etfrc.com. And I was just like looking, like trying it out, like just typing into different ETFs, and I typed in VT and VXUS just to try to see like the similarities between the holdings. And I was wondering if you could you go to that website and do what I did, because I'm trying to like
What's the website? Can you type it in the chat? Or
yeah,
just read it off to me.
It's www.etfrc.com. Yeah, that's it.
What were you looking at?
VT. I was doing VT and VXUS.
Shit. This is a pretty.
Hmm.
Let me show you. Okay, so this has a lot going on. I have to look at it. Let me show you a different one. Since
Okay.
you're doing Vanguard funds. Vanguard has their own kind of mutual fund thing. So just Google Vanguard fund comparison.
Okay.
And then you'll get to this page where it's going to ask you to compare funds and ETFs. Just hit compare. Don't select any yet, because I think there's a bug in there. But then it's going to ask you what you want to compare. So I'm going to type in VT. Oh crap! Forgot all of it. What's VT again? The total world.
Yep.
There we go.
Mm-hmm.
So VT. Let me add fund VXUS.
Okay.
It's going to show you two things. It's going to show you essentially all of the main pertinent data of the two. So the expense ratios, they're both the exact same. It's going to tell you what it is. So VT is the world stock. VXUS is international stock. So VT is the US plus the international markets. And then it'll show you that same kind of chart that we were looking at in the Morningstar example. And it'll show your first example, VT Blue has outperformed. This is based off a $10,000 initial investment over 10 years. You can update the years right here. And then VXUS has underperformed VT over 10 years. And that's just because the US market has outperformed the international market over the past 10 to 12 years by a long shot. So that exposure that VT has with the US market is why it is outperforming VXUS. But this is the tool that I use for my Vanguard funds and ETFs when I'm looking at or when I'm looking at Vanguard fund options.
So on like lines of diversification, would it be like wise to invest in both of those, or like just pick which one that you feel more?
Yeah. So if you just want a one-stop shop fund, you can just go with VT because that's going to be your US and international markets, or you can do two funds. But I wouldn't do both of these because they're both have international holdings. If you're going to do two, just do a total US stock market index fund, that's VTI, and then a total international stock ETF, which is VXUS. Vanguard itself, I'll even pull it up real quick, recommends, hold on, that you hold, in terms of your stock investing, they recommend to hold at least 40% of your stock holdings in international stocks. So if you see right here, to get full diversification benefits, they recommend 40% in stocks or in international stocks. Myself, I hold 30% just because I believe that the US market is the superior market and it's kind of globally diversified itself. What I mean by that is like you've got McDonald's, Walmart's, all these companies all over the world. So long story short, if you want to do, if you want that international exposure, just do VT or a combination of VTSAX and VTIAX. Does that make sense?
Yes, that's what I was thinking because I already have VTI and I was trying to figure out like I knew it wouldn't be like wise to put VTI with VT, but I was trying to figure out like which one would better like couple with my VTI. So VTX Okay, cool.
Yep.
Thank you.
Yeah, no problem. Sorry, that was a long way around getting you a short answer. Not quite sure what you're asking in this question. Sorry. I'm going to do two more questions. It's getting a little late for me. So if you guys want to ask it, or I'll just answer it here. So if you got any questions, shoot them to me before I close up shop.
I have a quick question. Did you mention whether you picked the Vanguard funds for a specific reason? Because I just noticed the others, like you don't have to have a minimum. You do have to have the 3,000 for Vanguard.
So I picked Vanguard because when I first started my investment journey, I was essentially reading every book that I could on investing. And Vanguard's name came up a bunch. And the reasoning because of that is its founder, Jack Bogle, was the first to introduce the index fund to essentially the retail market. What that means is essentially everyday people like you and me could invest in an index fund. That never used to exist before like the mid 1970s. People had to use brokers and brokerages to invest in all of these stocks to get them diversification until Jack Bogle came and provided the the Vanguard 500 index fund, which was the very first index fund created, to the general market and at a low cost. So I knew that from day one, Vanguard's morals and principles were right because they wanted to essentially allow the average person to invest in the stock market in a low cost way. So that's why I chose them. I knew their morals are right from day one. Not that Fidelity's and Schwab's aren't, but all of their low cost funds are essentially a result of it's actually called the Vanguard effect. If you Google it, a lot of companies now are forced to lower their fees because of what Vanguard did in pioneering index funds. So that's why I went with Vanguard.
Awesome. Thank you.
Yeah.
Hey, Sean, to convert a traditional IRA to your Roth, are you essentially saying you just have to pay the taxes on that traditional IRA money to move it into your Roth IRA?
Correct. So let me use an example. Let's say you make $100,000, okay? And you have $30,000 in a traditional IRA that you want to move to your Roth IRA. And if let's say you move it all at once, that means when you convert that $30,000, since it's pre-tax money, it's never been taxed, come tax season, it's going to read that you essentially earned $130,000 because it's essentially accounting for all that money that's being converted as new earned money. So you're gonna have to pay income taxes on that conversion. So if and when you do this, I would definitely, especially if it's a large amount, I would definitely get with a CPA. I got with a CPA. We devised like 3 to 4 different plans based because my conversion bumped me up into a new tax bracket. So just depending on, if you have the cash to pay the taxes, depending on what your tax situation is, you can do different strategies. You can convert a little over time. You can convert the entire thing. But yeah, you're going to owe income taxes on whatever amount of money you end up converting. Does that make sense?
It does. The next question would be, how does that affect in your annual $6,000 contribution if you're rolling over, say, a large contribution like that?
Good question. Rollovers and contributions have nothing to do with each other. So I rolled over, I rolled over 120 grand worth of essentially 401k money between my traditional and Roth 401ks, and I maxed out my IRA for the year for $6,000. That 120k had nothing to do with the 6k and vice versa. So you can still do your it doesn't count towards your contributions at all.
Got it. Thank you very much.
Yeah, no problem. All right, so I couldn't get to the last questions in this chat. If you want to DM me, I feel like, I was reading that question. If you want to DM me, shoot me a message at TheWealthDad. I thank you all for attending tonight. I really appreciate it. I like doing these demos, and look forward to speaking to you guys again. I believe I'm back on in 2 weeks. So hopefully you guys enjoyed that, and have a good night, everybody.